Thank you very much. We have some liquidity, which is always very good for markets and financial markets and insurance markets. So it says, thank you, for the invitation from on behalf of the OECD and IAIS, and this is good collaboration, and thanks for ANIA and also the work that was done under G7 presidency, and this was reminded us by the previous speakers. Obviously and unfortunately, we have seen also very updated tragic events happening everywhere in the world, and as Federico Signori was saying, the images we saw at the beginning, unfortunately, can be every day. We're seeing all the kind of flooding, earthquake, and all the kind of wildfire cyclones. And what is interesting, unfortunately, is that in some cases we can even see in the same places both extremes. While maybe in the past we would see, I don't know, flooding in some area and extreme, dry, and very high temperature. But now it's also the opposite. And this is disrupting, obviously, economic activity, create financial, hardship, and can generate, and we know, also fiscal risks. This is also destroying lives and destroying the morale of those who survive. So insurance can play a really critical role in assuming a portion of these risks and in providing a source of funding to help societies recover and rebuild. And so high, we have already, as been mentioned, high level of insurance coverage for natural hazard risks can reduce post-event economic contractions, speed post-disaster recovery times, and reduce so the disaster recovery burden on taxpayers. So it's good to be here with Pam, and again, the work that we are doing together is quite important. Now some numbers, and we will also, again, we collaborate a lot, and so we will exchange also the comments on the different slides with Pam. Now, why, our policymakers' numbers are clear, and insurance regulators and supervisors increasingly focused on this issue. My voice is still there, yeah. Now, firstly, the protection gap for natural hazard risks, if we use actually the rough measure of uninsured losses over total losses, is very large in many countries, including actually in Italy, and President Signorini reminded us, and also in many European countries. Now, this means that most losses related to natural hazards are absorbed by households and business without the benefit of insurance. And of course, government who will also face losses and will often feel compelled to step in to fill the gap, which is obviously the role of the government in some cases. Now, the burden on households and businesses is particularly high in lower income countries, where insurance penetration is low, and where the ability of government to support the uninsured is much more constrained than it is in Europe. Secondly, more progress we have done, but could be made in closing the protection gap for natural hazard risks. Now, the share of economic losses varies year to year, you see on the right, depending on the number and types of disaster and their location in the world. Now, while the gap remains high, it has declined by about 9 percentage points relative to the first decade of this century. Thanks, man. Now, a changing climate will mean increasing losses, other things being equal, as economists say, and so more expensive, insurance, and this will make increasingly difficult to make significant progress in closing protection gaps. We can already see this in many parts of the world. In the US, for example, increasing natural hazard losses and other factors have meant that the average household spent 30% more of their income on home insurance than they did in 2001. In Australia, there was a report released at the end of August, just recently, found that 15% of Australian households could be considered stressed, so affordability stressed, in terms of their ability to pay for some home insurance coverage, up from 12% just in 2022-2023. So you see, I mean, there's also anxiety when I was telling you about the morale. And in Canada and the UK, there are various reports that some banks are refusing. I mean, it's very difficult to provide some mortgages in areas facing high current or even future flood risk, and I'm sure that we will hear later in the following panel. So this comes where, you know, it can be useful to have public-private insurance programs. This can make an important contribution to broadening insurance coverage, protecting public finances and supporting risk reduction. Obviously, in countries with insurance programs covering earthquake or flood risk, they have obviously higher level of insured losses than those that don't, and these have a positive effect. I mean, this translates into, you know, smaller, you know, protection gaps, higher insurance market protection, and so reduce the financial burden on households and businesses. Pam. This is an uninsured risk.
Good morning. Primo, è un piacere, è un onore.
May say that it's a pleasure and an honor to speak and take part in this conference.
There is increased losses, increased costs, affordability issues, and stress on households and businesses. Now, this comes also with increased attention to the topic, luckily. Well, unfortunately and luckily. So I just want to set the scene on the international cooperation and the efforts we've made with the IAIS and the OECD and the G7. So it was in May last year that the G7 communiqué showed really appreciation and support for the fact that we will tackle this in a collaborative effort, and that's what needed. So we have gotten the support in the communiqué where there was actually looking forward to us addressing together the economic and financial resilience against all these natural hazards that we're facing. And also based on that, and as the wake-up call, with the IAIS, we have issued last year the call to action. And that's where we are, call to action. The call to action sets out the role of insurance supervisors, because typically insurance supervisors look at risks. If the risks are not covered by insurance per se, one would think this is about financial soundness and good business strategy. But eventually, this also goes to the value proposition of the insurance sector and to the consumer protection. So this is a call for action that goes across all mandates. We've seen that supervisors have different mandates across the globe, and it covers as much the financial soundness and a business strategy of an insurer as the consumer protection to actually make sure that contracts are clear, but also eventually the financial stability, as we see that a lack of insurance actually reduces the capacity of households and businesses to face financial stress. So that is actually a very important report that shows the willingness of the supervisors to engage and also the capacity. And we will come back later to all the 5 areas of action in which not only supervisors can take action, but where I see that many of you are already taking action. So Carmine, I'll hand over to the further work that has been ongoing.
Yeah, obviously we are on the OECD side. This has been a tradition also to work in this area, addressing protection gaps, and more, obviously focusing the work on where is, you know, it's more important. So, in particular to these, I mean, the gaps related to natural hazard risks, and this is part of my directorate, the Director for Financial Enterprise Affairs. And this part of the important work of our committee on that, the IPPC, so the Insurance and Private Pension Committee, which basically brings together, I would say, finance ministry typically, then depending on also the architecture in each country, and regulators. Now, in November 2023, it's in the slide, actually our council adopted, actually revised and updated OECD recommendation on building financial resilience to disaster risks. Now the recommendation, so approved by all 38 OECD countries, but then agreed also in the committee where there are other countries, so provides guidance for governments on how to manage the financial impacts of natural hazards and other catastrophe risks. So offering an important also framework for, to help policymakers navigate this complex challenge. Just very briefly, there are, I would say, 4 main elements in calling on governments. I would say first, ensure that the financial impact of disaster risks are properly assessed. Second, establish regulatory, policy, regulatory and supervisory frameworks that enable the availability and take-up of financial protection tools. Third, measure and manage potential fiscal risks. And fourth and lastly, implement an integrated and coordinated approach to building financial resilience. And then this year, and again, this was mentioned already many times, under Italy's G7 leadership, so the OECD and the IAIS so were invited to contribute some analysis on the potential role on public and private insurance programs, so in addressing these protection gaps. And this led to the development of the G7 high-level framework for public-private insurance programs under natural hazards, which was also welcomed by the G7 finance ministers at the meeting in Stresa. I should note that the development of this framework was a collaboration not only between IAIS and the OECD, but then obviously the Italian Ministry of Finance, and I really want to thank them, but also the climate change mitigation working group members. And so we very much appreciate all the fruitful discussions and thoughtful input throughout. Again, Signorini was mentioning also that. And now the G7 framework provides critical guidance on how to approach the implementation of the elements of the recommendation, so related to ensuring the availability and take-up of financial protection tools. Yeah, we can go, and then this will be the core of our presentation. Now, the G7, let's try with mine. Okay, we should change the slide. Okay, yes. Now, the G7 framework basically provides a step-by-step a guide to addressing protection gaps in natural hazard insurance, beginning with an assessment of the protection gaps that could lead to financial vulnerabilities as a result of damages and losses related to natural hazards. This is followed by a discussion of the different measures that policymakers, insurance regulators and supervisors and the insurance sector can take to reduce protection gaps. And these 2 steps will ultimately help to basically policymakers to see whether public-private insurance programs or the PPIP could be a useful approach for addressing protection gaps. The final element on the right outlines, or the framework outlines consideration for the design and implementation of PPIPs. Should countries decide to establish this type of arrangements as a response to protection gaps. And so now we will go with Pam through each of these components in turn, and Pam, the floor is yours.
Thank you, Carmine. So indeed, the first step is about assessing and identifying the gap. And there are 3 main components to that. Of course, we've already heard the increase of the hazards, the perils, the windstorms, the floods, the earthquakes, of course, also, which come into account if we think of natural catastrophes. So the hazards, but also the exposure, so the wealth exposure. This is, of course, different coastal regions, developing countries, Europe, versus other jurisdictions. And the other topic that needs to come into account is actually the vulnerability. And then we speak of awareness, of risk literacy, of people living and not having the insurance that is needed to cover them. A second element that needs to be taken into account, and we've heard it already, I think we're repeating sometimes each other, but I think that's why we're consolidating the framework, is we have to look at the demand as well as the offer. So that the offer is an issue of insurability. Are insurers still able, willing to enter into the market in special risk regions? Are then also insurance policyholders or citizens sufficiently aware of the offer and sufficiently willing to buy? And we've heard that there are different obstacles to that. So look at the demand, look at the offer. What is underlying the issue of disaster risk prevention is also a key behavioral aspect. And it's not just a personal behavioral aspect, but also an institutional sclerose of not taking preventive action. And we've heard this many, many times. We always mention the prevention, and that is actually what we see today, which has been lacking in the past years in the infrastructure. And that is where this coordinated action should actually undo this moral hazard where the insurance sector or the governments or the consumers are waiting for each other to take the right measures. And that is actually underlying the identification of the issue and of the options. Because then we see that there are different tools and different actors who can take measures, but who should take measures in a coordinated manner. Because one can spread money in prevention measures, but they have to come together in an overall effect. We have to be able to monitor this at a regional, local, and global level, whether actually all these incentives and initiatives are making a difference and are not just greenwashing in the end. So if we go to the second slide, or the next slide, it works. Carmine already mentioned it, and I think you start to see the structure, all the pillars, and this is also reflective of the call for action, the paper that we issued with the IAIS. What are the different strands of work? And if we internalize these, we can monitor our actions according to this. So I've just identified the first one, is the risk identification. You see the second and the third, improving risk awareness, improving financial literacy, incentivizing and investing in risk reduction. Without going into the details, but this is all about ex ante. And this is also, if you have one message, it has to do with investing in advance. Because we've heard the economic efficiency, the cost of intervention of 10 billion when the floods have happened is a very costly measure. And this can be reduced by preventive ex ante measures at the level of the risk awareness, very basically, but also at the level of investing in risk reduction. And with the IAIS, we have also identified that there are different initiatives. What we would like is to monitor whether these initiatives are actually coming to fruition. There are initiatives in Slovenia to look at the causes of underinsurance, in Japan to engage in a dialogue with the insurance sector why the policyholders are not taking up sufficient coverage. There is evidence in Zimbabwe where there is financial education in schools. So this is a level of action which, if it all comes together and if we're aware of each other's initiatives, this can come to fruition. But also the risk prevention. Some examples, in New Zealand, the insurance scheme is actually proactively telling to homeowners what the prevention measures are. So we can do more on that. But also the UK Flood Re is actually incentivizing the Build Back Better, which is not a typical insurance compensation approach. It's to build back better, maybe in cooperation with the authorities to build back somewhere else. The transition, the financial costs that this will need to entail are very important to also address. And we've also seen the premium reductions, which, for example, in California, are given to policyholders for actually taking measures to prevent or to mitigate the effects of wildfires. So those are these very, they're not anecdotal, they're the fruit of very thoughtful thinking, but we have to see how this comes together, because we have a global insurance community that actually has also to be globally reinsured, and all these measures have to come together. The third area is actually about regulation, market access, pricing flexibility. What is beneath that? It has to be a risk-based system. There is, of course, a need for solidarity, for subsidies, but one has to be aware, based on the first step, what is the risk? And there we can also have digital technologies, of course. We heard about parametrics. We heard also about modeling. In Chile, there is the FinTech law that enables parametrics, but also in Costa Rica, the Global Risk Modeling Alliance, they're modeling. We've just seen also in California, the model for wildfires have just been very well promoted by Ricardo, Lara. So what we see there, we need data, digital data, but also innovation in products. And that should also enable access to insurance products, microinsurance, we heard this also, but on a risk-based approach, on an insurance-based approach. And of course, assessing the viability and necessity of PPIPs, Carmine will continue to tell you what are the implications and the trade-offs there.
Yeah, because the issue is that obviously we need, the magic word, a holistic approach. And so on the one side, okay, and Pam described, and it's important, the supply and demand. By the way, we had a discussion last week, as you know, at the FSB, actually, SCAV, the Financial Stability Board. And, you know, because you cannot have without one of the two sides, and I have to say I'm quite biased also, and this idea of raising awareness and, you know, the financial literacy, awareness, and people need to understand, and also when it was mentioned before by President Vivas, that also in terms of also what the industry should do, in terms of also the clauses, and you know, people should understand. But so it's critical, okay, to invest in these, in all of these. But then there is, I would say, this. Let's call it the third pillar. So in many countries we have PPIPs already initiative, and they, you know, they've been established to help to reduce, you know, production gaps and to promote, you know, the affordability and availability actually of insurance against these risks. Actually, okay, PPIP may mean different things to different people in different countries. That's why maybe the framework can be useful. So what the idea is that these are programs that have been created, and the focus is to pool and share natural hazard risks to households and businesses across the insurance sector. So we refer formally to these arrangements as catastrophe risk insurance programs. They involve always some sort of risk pooling and or sharing across the insurance sector. So typically with a co-insurance pool. They may also include other kind of risk sharing arrangements with governments delivered maybe through a public insurer or reinsurer, or some form of government backstop, provided to, you know, private reinsurer or insurers, or to the sector as a whole. We have also, you know, examples. This is not completely new. Okay, the Consorcio de Compensación de Seguros in Spain was established actually more than 8 years ago. The natural flood insurance program in the US is approaching 60 years old. The Swiss system actually of public real estate insurers and insurance pools is more than 100 years old. So what's important is that the number is increasing, whatever, you know, they are. The last time actually that Italy chaired G7 in 2017, there were catastrophe risk insurance programs that covered flood in 10 OECD countries, and now it's 14, which is a 40% growth in 7 years, which is not bad. With the same basis, we hadn't new OECD countries after that, so we're not cheating. When thinking about developing this type of public-private insurance program, there are several elements that should be taken into account, and this is outlined in the G7 framework. I mentioned basically 4, you know, objectives. The first thing is to achieve, you know, the objective or objectives that the program should aim to achieve. And basically the framework proposed 4 objectives: ensuring the broad availability of affordable coverage, leveraging the available private market capacity, third, limiting public sector exposure to natural hazard risks, and 4, encouraging risk reduction and adaptation. So a program could be designed actually with the aim of achieving all these objectives. They are not necessarily mutually exclusive, so they're not necessarily trade-off in that, but then maybe striking the right balance is good. Because there are, in any case, some trade-off possible, and so government policymakers may like to put more emphasis on some objectives over others. The second element, I go quick also because we have to close. The second element in the framework involves a consideration of possible design features, and these include the eligible hazards and policyholders, the type of financial protection provided through the program, whether the program coverage would complement or substitute for what is available on the market. Pam mentioned also an issue is a premium setting and for example, so the extent of risk-based pricing incorporated into coverage, as well as whether there are any requirements related to the purchase or offer of program coverage. Okay, and finally, maybe just go a bit faster. So the framework highlighted the importance of considering implementation needs. And these needs include the role of different government agencies and ministries. In some cases they're different, and decided who should be responsible and accountable for various design decisions, because sometimes it's not so clear. There may be also a need for new institutional capacities to manage the government role in this kind of program, and also to consider the appropriate application of insurance regulation and the role also of insurance supervisors. Yeah, let's change. Now, just quickly, what are, trade-offs? A few examples, trade-off, for example, between an approach that aims to ensure broad coverage and broad access to comprehensive coverage and efforts to leverage private market capacity. And here it will be, in this scenario, will be likely difficult for private insurance to contest actually the market, and if a program is meeting most of the financial protection needs of households and businesses. And again, Signorini mentioned, we need also competitive markets. This is in the interest actually of the industry. Also, trade-off between maybe an approach that aims to ensure that program coverage is affordable for all, and efforts to limit final cost or incentivize risk reduction, striking the right balance. We should be careful, because also this could provide also maybe a little incentive then for those at high risk to invest in risk reduction. This is basically, let's say, flood the market with so easy. Maybe let's change again, and then protection. So just also on still on our ongoing work. We again keep on working. We are going to have also committees in the next weeks. We are currently looking, as also I mentioned, very quickly to the design on flood risk insurance programs in OECD country, actually with a focus on how different design approaches impact the achievement of possible objectives in the G7 level framework. The IPPC is also beginning to some work on evaluating the benefits and limitations of an insurance-based approach, like, again, the PPIP in the framework for addressing large-scale catastrophes. Pam, on the IAIS?
Yes, and on the side of the IAIS, actually, they're discussing this week in Washington the next strategic themes for 25-29. But what is clear is that one of the three strategic themes is that the IAIS wants to support the insurance industry in actually playing its role in building resilience. And that is a topic where protection gaps will feature mainly. So we will see what concrete actions still, because I have to see on which ones they agreed with the task force. But what is sure, as I mentioned, monitoring. We have to monitor the action. We can't come up next year when we will be back here, have anecdotal evidence of something that may have worked. We will see what the Italian law will have brought in insurance penetration and in prevention. That is what I would like to see. But also what we need to do is share the supervisory practices for that, because we shouldn't always invent the water, because I think there are so many activities. We have to implement the framework now, and I think we can go forward with that. just to mention two activities in particular, we will be looking at the financial stability impacts of protection gaps, because we've heard the impacts potentially also on the banking sector, on financial stability, on the economy, on resilience generally. So insurance has a role there. And what we will also be maybe looking at, let's see, is also the role of insurance protection gaps in agricultural insurance. It's a hot topic, but it's also crucial in ensuring resilience of our society. So that is something which I wanted to share with you, and then you will see in the next weeks more details on that.
Yeah, I mean, and again, I think it has been good not only to work as we currently do also with IAIS, but to contribute to this framework. Now, the framework we were mentioned yesterday at dinner, I mean, it's not rocket science, it's not the silver bullet, but really we think and we hope that you appreciate it, you know, because sometimes, you know, we need also some coordination top down. It's also important, you know, sunlight is the best of disinfectants, to share information, to share experiences, to disclose. And we really hope that these also, again, a broader, would say, a PPIP in a broader sense, so collaboration, you know, authorities, policymakers, the market, and, you know, there are no borders in this catastrophe, what's going on. So these, we really need an approach at the international level. So it was great that the G7 also, you know, support these, and we can go, you know, further in these, in then implementing. So thank you really very much on behalf of the OECD and IAIS.
Thank you very much.